Welcome to Informed Investor. Today, we'll talk about IndusInd Bank because it's making headlines as its shares have fallen drastically by a significant 25%, hitting its 52-week low primarily due to account discrepancies. But before this, let's do a quick market update. The global financial landscape is experiencing significant turmoil with both the US and Indian stock markets facing substantial declines. In the US, major stock indices have plummeted by up to 4% due to growing recession fears, intensified by President Donald Trump's comments on tariff policies and the potential impact on the economy. This volatility has rippled across the globe, impacting emerging markets like India as well. The Indian stock markets too are experiencing a period of decline, reflecting the broader anxieties about global economic stability. Okay, now back to our main story. First, let's do a quick business overview. IndusInd Bank is India's fifth largest private bank, established back in 1994 and headquartered in Mumbai. It offers a wide range of banking services for individuals and corporates, including microfinance, personal loans, commercial loans, vehicle loans, credit cards, and SME loans. It boasts of having 42 million customers across segments with more than 3,000 branches and ATMs spread across India. Now, what is the news and why are the shares falling? IndusInd shares have fallen drastically by 25% today due to accounting discrepancies discovered in its derivative portfolio. The bank had conducted an internal review following RBI's directions on investment portfolios, which revealed discrepancies in account balances related to derivative transactions. These discrepancies are estimated to impact the bank's net worth by approximately 2.35% as of December 2024, translating to a post-tax impact of about 1,577 crores. The discrepancies pertain to foreign currency deposits and borrowing conversions, where the bank's internal hedge methodology differed from the external hedge, leading to over-reporting of net interest income and trading gains. This issue has been ongoing for about 5 to 7 years, affecting the bank's financial reporting and profitability. But these are not the only concerns. Over the past 6 months, IndusInd shares have fallen by more than 50% on the back of several negative events. Now, despite being the second largest microfinance lender in the country, the recent quarters have witnessed a slowdown in the microfinance loan book, and more importantly, it has seen an increase in microfinance stress levels, leading to higher NPAs in the segment. Second is the resignation of the Chief Financial Officer, Mr. Gobind Jain, ahead of the December quarter results, which added to investor uncertainty. Thirdly, the current CEO, Mr. Sumant, received only a 1-year extension instead of the expected 3 years from the RBI, raising questions about leadership stability. Now, what could be the potential impact on the bank? These challenges are likely to impact IndusInd Bank's financial books negatively. The discrepancy in the derivative portfolio could lead to a hit on the bank's net worth by 2.35% as of December 2024, affecting its capital adequacy and profitability. Money Control reported that this could potentially impact its profit by 1,500 crore. This loss will be accounted for either in Q4 of fiscal 25 or the first quarter of fiscal 26. Additionally, the microfinance stress and the leadership uncertainties may result in reduced investor confidence, potentially affecting the bank's ability to attract new capital or maintain existing business relationships. With the stock price falling severely, no doubt several investors have taken the hit. But the biggest hit is taken by mutual fund houses, as around 35 mutual funds collectively held over 20.88 crore shares of IndusInd Bank. The value of these holdings stood at Rs 20,670 crore but has now declined to Rs 14,600 crore after the recent stock correction. Now, following the news of accounting discrepancies, several brokerages have downgraded their outlook on IndusInd Bank stocks, citing discomfort with a series of negative events and concerns over the bank's credibility. The sudden drop in share price and the potential financial impact have led to a cautious stance among investors and analysts. Brokerages are adjusting their target prices for the stock, reflecting a more neutral or pessimistic view of the bank's future performance. Now, to conclude, the recent events at IndusInd Bank highlight the importance of strong leadership and robust corporate governance in the banking sector. The multiple negative events have raised questions about the bank's internal controls and risk management practices. The limited CE tenure extension, coupled with the CFO's resignation and the portfolio discrepancy, points to potential governance challenges. In the banking industry, where trust and stability are paramount, such issues can have a significant impact on investor confidence. Only time will tell how IndusInd Bank navigates these challenges and restores its credibility. The bank's management will need to take decisive action to address the concerns raised and demonstrate its commitment to transparency and sound governance. Now moving on, let's quickly go through some other important market updates. To provide some more respite, Finance Minister Nirmala Sitharaman said GST rates will be further reduced with tax slab rationalization nearing completion. The revenue neutral rate has already dropped from 15.8% in 2017 to 11.4% in 2023. Final decisions are expected in the next GST Council meeting. Next, IRFC shares are in focus as the board will meet on March 17th to consider the second interim dividend with the record date set for March 21st. The recently designated Navratna PSU has shown strong financial performance with revenue exceeding 26,600 crore and net profit over 6,400 crore. Moving on, NTPC Limited and its subsidiary NTPC Green Energy will invest 96,000 crore in Chhattisgarh for nuclear, hydro and renewable energy projects. The agreements were signed at the Chhattisgarh Energy Investors Summit 2025. Lastly, shares of automakers and gas suppliers fell yesterday after the Maharashtra government announced a 1% hike in motor tax on CNG and PNG four-wheelers and a 6% tax on EVs priced about 30 lakh. The move, part of the state's budget, is expected to generate 150 crore and 170 crore in additional revenue respectively. Maruti Suzuki, MGL, Tata Motors and Mahindra saw declines while Nifty Auto ended 1.22% lower. The new tax rates will take effect from the upcoming April 1st. Now having said that, this is me, Rahul Hassan signing off. Have a great day and stay safe.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.